Ladies and gentlemen, welcome to the Grants podcast. I am Jim Grant. I founded this publication and continue to edit it. And I want to talk today with my deputy editor, Evan Lorenz. Hey, Evan, how are you doing?
I'm doing good, thank you.
Excellent. Talk about the name in the banner, that is interest rates. Grant's Interest Rate Observer is the name of our sheet, our publication, 12 pages every 2 weeks. And you know, when I founded this thing in 1983, we actually had interest rates. God, they were fabulous. You'd put money in the bank, and pretty soon you'd have more, owing to the accretion of capital through the compounding of interest. Then came the great financial crisis at some length, and interest rates seemingly vanished. Evan, time does fly, and I got into the business well before what turned out to be the beginning of the greatest bull market in bonds, probably in history. It began in October of 1981, on the 1st of October to be exact, and it has lasted possibly to this moment. We now speaking early 2017, but you know, we at Grants think that that it ended in July of 2016, which would make it a 35-year bond bull market. Mm-hmm. Pretty fine. So what I would like to talk about today with Evan is the nature of cycles and interest rates. One of the funny things about the bond market, about fixed income securities, about the interest rates that define their value, is that these interest rates tend to move in generation-length cycles, up and down. Nothing like this in other departments of finance, as far as I know. I mean, stocks don't move in generation-length cycles, and neither does real estate. But you know, in this country, in America, interest rates peaked around the time of the Civil War. This is the 19th century, about 1865, 66. And they declined more or less persistently until about 1900. And they rose from 1900 to about 1920. And they fell from 1920 to 1946. And they rose from 1946 to 1981. That was also a 35-year cycle. And as I say, perhaps they have described a 35-year arc of decline these rates have from 1946 to 2016. Why this pattern exhibits itself, I don't know. I have asked around, I've thought about it. I can't come up with an answer, but it seems to. One can't dogmatize, but it seems to. Now, some of these cycles are outside of American experience, or much longer. So in Britain, bond yields, government security yields, they call gilt yields in Britain, fell from about the time of Waterloo, about 1815, till about the close of the 19th century, along about 1895 or 96. Remarkable. You know, Evan, so that one of the great questions, of course, is let us hypothesize that rates did indeed describe a generation-length bottom, did execute this great event, this cyclical climax in the summer of 2016. So one question is, well, how would you read that? What makes you think that? And a second question, I guess rather more pertinent, is so what? Then what? What does history say about the next cycle up? So, you know, in the summer of 2016, we collected some anecdotes taken from headlines that showed a positive compulsion on the part of investors to own fixed income securities. One of the more striking of these headlines, and I'm going to ask Evan to read some of these things. He's got a much better reading voice than I do. One of these headlines showed that that people have come to regard bonds not as income-producing vehicles, but as kind of islands of safety. they thought that something about bonds were intrinsically safe, which is kind of an amusing thing, given that back in 1980 and 81, bonds were dubbed certificates of confiscation, meaning they were intrinsically unsafe, so said people. And they were not intrinsically unsafe then, nor are they intrinsically safe now. But here are a couple of headlines that, I don't know. Evan, would you favor us with a dramatic reading of some of these things? Where there are three of them, starting with something in the junk bond market. You might remember them rather well, Evan, because Valvoline at the top.
Valvoline's junk bond deal leaves investors clamoring for more. Hot money fleeing negative yields shelters in outer Mongolia. Yield stampede sends emerging bond flows to fresh record. One of the things remarkable about a long cycle is people tend to take that as how the world always works. Yeah. There's been a lot of business models on Wall Street built up on the idea that stocks and bonds should be negatively correlated because every time there's a problem, bond yields will go down and stocks will go down, which means that bond prices will go up. One of the big investment flavors du jour is risk parity, where people implicitly lever up a portfolio of bonds to hold against a portfolio of stocks in order to balance out the risk between the two of those. But if we really are going into a bear market in interest rates, bond yields could rise even if stock prices fall. I'd love to kind of understand, what do you see for investors who are trying to put capital into to work in the market today about what this means for their portfolios?
Yeah. Well, I think the now and ever the great touchstone of investing must be a margin of safety and evident value, or indeed prospective value. That is also very important. But let me at least describe what happened the last time there was a turn in interest rates from falling to rising. And this, the year in which rates bottomed was 1946. Now it happens, Evan, I was born in 1946. I know I only look like I'm 30 years old, but I was born in 1946. And I was born in July. Now, the bond market bottomed in April, and I wasn't around for that, but my mother filled me in the few months in which I was not around. And long-dated yields bottomed in April 1946 at about 2.08%. Now, that's not so very different from the yields that were on offer last year. Actually, they were different in that it was a positive 2.08. You could, in 2016, find upwards of $15 trillion worth of sovereign bonds that were priced to yield less than zero, which is something heretofore unseen in 5,000 years of recorded interest rate history, which, by the way, is a sighting that led us at Grants to think that something perhaps was excessive about bonds in the summer of 2016. But in 1946, rates bottomed in the long-dated Treasury at 2.08%. So, a question: how fast did rates go up? Well, they took their sweet time. They took 10 years, did the same securities, 10 years, to get to a yield of 3.08. So that's kind of encouraging, right? It means that there's not necessarily any hurry about it. And then it took, so that was 1956, 100 basis points, or 1 full percentage point in 10 years. And so fast forward 10 years to 1966, and the same kind of security, long treasuries, were at about 4.5%. So there was nothing apocalyptic about the move from low rates to higher rates at the start. The first 20 years or so was rather measured. The Fed seemed to be in control of things. Inflation was measured. In fact, for about 12 consecutive months, 1955, 1956, the CPI printed at a negative rate, meaning there was negative inflation, what we call in the trade deflation, and nobody cared because the prices were down. They thought that was good. The shoppers thought that was a good thing. Oddly enough, they thought it was a good thing to go into a store and find things that were cheaper. Now there's an entire ideology built up against such a sighting and prices, but so it was 20 years of very measured upside movement in rates. And then kind of all hell broke loose. 1967, 68, 69 were years in which rates they became 6% and then at 7%. Nobody had ever seen the likes of a 7% Treasury since at least the Civil War, when the Union itself was in peril. I remember so well the salesman telling me at the time, you had to own this, 7%, fabulous. And today, of course, we would say, fabulous, 7% from a Treasury security, who could imagine it? But back then, 7% became at length 8%, and then 9%. And all this was in the context of a world monetary system that was popping rivets and coming close to breaking down altogether, which it did in 1971. The Bretton Woods system, by which the world's currencies were fixed as to exchange rate, and they were all tied to the dollar. The dollar was exchangeable into gold at $35 to the ounce, and the other currencies major currencies were tied to the dollar at fixed rates of exchange. So at one remove, they too were exchangeable into gold, in theory. That broke down in 1971. In the breaking down, the world of interest rates was rattled. So the 70s progressed. They were a time of brutal inflation. People today talk blithely about how they want more inflation. Yeah, be careful what you wish for. Prices rising at 3 and 4 and 5%. Well, that was kind of uncomfortable. Then it came 6 and 7%, 8%, upwards of 10% by the time the Carter administration had run its course. And by the time the Carter administration did run its course, the dollar exchange rate was being pummeled and inflation was running in the double digits. And long-dated treasuries were yielding not 7, not 8, not 9, but 10%, on their way to 15%. 15%. And this was after the hero of the inflation cycle, Paul Volcker, had come into the Federal Reserve in, I think, 1979. And what to me is so striking and in good measure inexplicable is the final blow-off of yields, the final give up of all the bond hopefuls, of all the bulls who wanted to own these securities, paying yields never before seen, 10% certainly never been seen before, at least not in modern times. And the bulls who wanted 10% and got it wanted 11%, a little bit less, because that meant the bond prices, of course, were falling. They wanted 12%, still less, and by the time it got to 13, 14, and 15%, they wanted out. And that is a little laboratory in human behavior, right? 15% is a much better deal than 10%, but it also brought with it the fact of loss of principal and the prospect of still more loss. Bonds then, as I said, being blackguarded as certificates of confiscation. So that was the state of affairs in 1981, and by that time commodity prices had peaked, and Paul Volcker was plainly in charge. The Air Traffic Controllers Union had buckled under the Reagan administration's tough love, and it seemed as if the problems that had blotted and terrified, really, the 70s had been put in the rearview mirror. That's what it seemed like. And at long last, 1982, the stock market got up ahead of steam. It went up. The world seemed to be mended, and America seemed to be well launched into an era of controlled inflation and falling interest rates. But then something happened. In 1983, 84, yields, instead of conforming to script and continuing to fall, actually went up again. And in the springtime of 1984, 30-year treasuries were priced to yield 13%, 13 and a quarter, 13 and a half, 13 and 7/8, and one day, about in May, one day, I think they touched 14%. 14%. And you could have bought them in a zero coupon form, thereby eliminating reinvestment risk, reinvesting those coupons. That was all done for you by the arithmetic of a zero coupon security. You bought it at, say, 40 cents on the dollar, 35 cents on the dollar, and you redeemed it at 100 cents on the dollar. All you had to do was buy it. One decision stock, bond. It touched 14%, did this particular bond, at a time when the CPI, consumer prices, were printing at 4%, or I think even a little bit less. There was almost 10 percentage points of real inflation-adjusted yield available to people who would only, if they only had thought that the Treasury wasn't going broke, and that the Federal Reserve was not going to reinflate the system. So all of this history is in the service of the observation, my observation over the course of many, many years of observation. It's in the service of the truism that that markets, which supposedly and rightly ought to be looking ahead, sometimes they look back. Mm-hmm. You know, people say the markets are efficient, and I agree. I think the markets are efficient to a degree. They are just as efficient as the people who operate in them. That is my reading of the efficient markets doctrine. And in the springtime of 1984, they were efficient, or efficient, I suppose, deserves a rigorous definition. I will forestall and put that off another day. But I think that we can at least agree that in 1984 the markets were not especially forward-looking.
In 1984, people demanded high interest rates because they thought the government was going broke. Today, people demand de minimis interest rates because they think the government is apparently solvent. In 1984, net federal debt as a percent of GDP was 33%. Today, it's 82%. I'd love to get your thoughts on the perception of investors and how those perceptions actually match up to reality.
I think the every market needs a narrative. Mm-hmm. And often I think that the stories are manufactured to rationalize conduct that would have occurred anyway in the absence of the proffered narrative. But a narrative it kind of makes everything seem at least defensible. So if you're going to forswear the opportunity to buy what amounts to an equity return with no equity risk, you need some pretext, right? You can't just say, I'm not going to do it because I don't feel like it, because I don't feel like getting 14% risk-free for 30 years. You have to say, well, I'm going to forswear it because the government's fiscal situation is adequate. The Reagan administration is spending us into rack and ruin. That was part of the storyline at the lows in bond prices and the highs in rates. So I think that I think that oftentimes the things that you read, the reasons that you read for market action on the web or in the newspapers or even in Grant's Interest Rate Observer are reasons that people produce because they have to meet a deadline, because they need to fill this space with something besides the market went up or the market went down. That's very dull copy. Rare is it that anyone making a career in finance sees something truly new. Most everything has a precedent. Human beings have been dealing with money, profitably or otherwise, for millennia. But we live in a time of actual novelty. Negatively yielding sovereign debt is one such novelty, and it is a doozy. So interest rates, unusually, if not uniquely among financial phenomena, tend to trend in these long generation-linked cycles. And one forecasts at one's peril, but one must still think about the future. And what we at Grants have come to conclude is that, yes, a 35-year cycle of rising bond prices and falling bond yields ended. It ended in the summer of 2016, at which point we said, and I now quote, leave it to an author to quote himself. I'm going to quote Grants. If practice makes perfect, Grants is unrivaled in calling the top in bond prices. We have done so repeatedly and over the course of many years, even if not lately. Since 2014, our line has rather been one last gasp for the bulls. We now say, I continue to quote from us in July of 2016, we now say that the last gasp has been gulped. With all the fluency that comes with study and repetition, we say that sovereign debt is the biggest bubble since the Bronze Age, or maybe since ancient Sumer. The notion that negative yielding bonds denominated in a fiat currency are a safe asset is a misconception that belongs in the next edition of Extraordinary Popular Delusions and the Madness of Crowds. And that is our final say on the subject.